Today, folks, the average bull market lasts around 3.8 years. No bull market cycle is the same, but when you got things like Dog with Hat, a shite coin, going to the bloody moon of up over 800% in a month, you got to question yourself, is this more of the 2021 speculative hype market, or is this really truly a new bull market for all asset classes? Well, that's the question we're going to ask as I point out where I believe there's true value in this market, because I still think as we head into an interest rate cut cycle, we're going to see a bit of a bullish rally in other companies that are more dividend focused, but tech companies are actually starting to look favorable. Like, we're seeing a lot of crashing in some of the Magnificent Seven, which we're going to discuss in this video. But yes, the average bull market over this historical period of basically since the S&P existed, or since 1932, has been about 3.8 years, with the longest bull market in human history being from 2009 to 2020, which was honestly one of the greatest years ever in the S&P 500, one of the greatest decades, because you couldn't do no wrong. Quantitative easing after the almost collapse of, the US real estate market that actually collapsed global markets like Greece during the time. Like, it's incredible to see what's happened after the fact. And if you zoom out, it actually looks like we're still on that same bull market, but these cycles that are happening over the last 5 years are compounding and being much more vicious. The pandemic really took us into a whirlwind that we haven't kind of nominalized out of yet, because from the bottom of October of 2022, we're only about a good year and a half into this new bull market cycle, right? And the PE multiple expansion that happened again from the earlier 2010 period, that decade of that multiple expansion was smooth. Like, companies were just gaining in momentum and it was bringing up values overall. But now, because we're at these really high multiples, that leads to a lot more volatility, right? And volatility can lead to outsized returns, but you're gonna find me being fairly pessimistic in this video overall. But honestly, that's not gonna detest me from cost averaging in the S&P or looking for some of these discounted opportunities. So again, as pessimistic as I'm going to be, take it with a grain of salt, because you can never be bullish, because long-term bears always get slaughtered. So anyways, taking a look, I discussed this yesterday when the market started to tank before it just immediately recovered within the last couple days. We can see the S&P 500 now is purely tech companies. Even Berkshire Hathaway, arguably not a tech company, but the vast majority of its positioning is in Apple, and the only reason that it's still sitting in the S&P top 10. But long are the days of ExxonMobil's and JP Morgan's and traditional healthcare like Johnson & Johnson are sitting in the S&P top 10. It is purely tech companies, and Nvidia, Broadcom chip makers are starting to rein up a good majority of this. Nvidia is now competing with Apple's market cap as the third largest company basically in the US, right? And Microsoft is dominating at about $3 trillion in its market cap. Apple, now down to $2.6 trillion, is passing its crown off as the higher interest rate market takes effect on people's purchasing power with high value products like MacBooks, right? So it's going to be really interesting to see how this pans out here. But let's just do a quick comparable of Nvidia's valuation versus Apple and just show you what you're getting for almost the same price today. And it is truly jaw-dropping, and this speculates me that we are heading in the midst of this bull market into another bubble that's going to lead to some volatility. There's no doubt in my mind at this point. When you got a company like Nvidia, and we're going to take a look at guidance here as well, generating for the last quarter, we're not going to do the annual report, just quarterly, because these companies continue to grow quarter over quarter. It'll resemble the better growth that's been priced into the stock. But with $22 billion in revenue, they've managed to net about 12.2. So keep that in mind, 22 and 12.2 net income. In comparable to Apple's last quarter, Apple did a whopping, keep this in mind, $119 billion of total sales revenue here, and they had net income, if we scroll down here, of almost 34 billion, right? So 119 and about 34. 119 versus 22 and 34 versus 12.2 billion. Like, do you know how much you're paying for the future growth of Nvidia today? And again, keep in mind their guidance isn't that high. Now, they've beaten guidance expectations always, but for Q1, they're only expecting to be about 24 billion plus or minus 2%. So 24 billion is really only 2 billion higher than last quarter. Like, I feel like we're starting to hit that critical curve where there's just no way Nvidia is going to be able to continue keeping up with the same growth rate it has experienced in the past, which means eventually we're going to hit parity with the growth it's experiencing. But if there's any hint of falter or any hint of some kind of further pressure on this market, we're heading for a soft landing, and it feels like we're in a soft landing for sure. But if there's just a hint of something bad, these companies that are highly speculative, these cryptocurrencies that are highly speculative, that's what bursts these markets, right? And again, these are trading companies. Like, if I'm buying momentum companies like Nvidia today, even Microsoft, which is largely driven from the AI conversation, like, I am taking profit here. Like, there's just no way that you can be holding these companies individually and sit here and feel comfortable about how they're currently traded. Right now, Microsoft proving to be a much better business as a software business over Apple, which is a product-focused business. But I'm looking at companies like Apple, like Google. I mean, remember one day when Meta used to be the value a bunch of the market, but now it's some of these larger cap companies that will have real potential as the full bloom of a new bull market. And my definition of a bloom of a bull market is when the consumer is stronger. Because at the end of the day, the consumer's just not that strong. The consumer's not the one pumping Nvidia and these chip companies to the moon. Keep that in mind, right? Like, that's business to business. If you wipe that out and you look at the broader economy, I think Apple is a better representation. In fact, I even think Tesla is a very good representation of the average consumer because they're the ones buying cars. And when they can't afford the car, Tesla's got to cut prices. When they can't afford the MacBooks, Apple's got to try and cut prices or do something to entice them to buy other products that might be cheaper, like the Apple Watch, which was the big push, last Christmas. And even that couldn't get them out of the gutter, right? So you kind of got to keep that in mind. And you want to look at these companies that people just don't give a crap about, that they're crapping on religiously, Google, Apple, as tech companies. But even in the realm of dividend companies, like, I'm still very intrigued, and I'm glad that a huge percentage of my portfolio is in like the Schwab US Dividend Equity ETF, because I still think there's a lot of value in a lot of the holdings in those companies, like Verizon. I mean, Home Depot's in there, companies that'll get much better when the economy recovers. Because even if the economy recovers and people have more dollars to spend, that it will continue to go to companies like Google, because they'll have more money for marketing spend. They'll have more money for Apple, be able to buy more products and build out their business. But companies like Microsoft, where they priced in so much of the future thanks to AI, even if they cut interest rates, I still feel like those are the kind of companies that are going to have they're still going to have a hard time justifying these values. So I'm really intrigued by dividend companies, especially in VDY. I mean, I still love the Vanguard, monthly paying Canadian dividend. I'm going to be buying this back. Even my wife, we have exposure to this stuff. I've been meaning to start averaging back into these things, but I've been looking at tech companies that I just think over the long run, and when I mean long run, I mean the next 3 to 5 years, have much more value than some of these Canadian banks. But I do recognize that the yields are still nicely high. Like, we're still at really good high yields on these ETFs like SCHD, which is SCHD is recovering nicely. I mean, we're pulling back out of the bear market, but we're not at all-time highs. You're still getting a 3.5% yield on average. It's continuing to go up. Same with VDY. A lot of these Canadian companies are increasing the yields, and these are good places to be looking at still when the market is so excessively valued today. And I just kind of want to round this conversation off, is that you just don't want to get caught in the hype. I mean, the people that sold the bottom are the same people that are going to be buying the tops here. And again, we're talking about crap coins. Bitcoin is the conversation in and of itself. I wouldn't be surprised if Bitcoin runs up to 100,000, but honestly, it only just takes no more buying pressure. If there's no more buying pressure, there's a hint of fear. And when you own assets that can only go up from other people buying them, not from underlying businesses, you gotta be a little skeptical of what you're doing, right? And just constantly stay on course and remind yourself cost averaging is the best thing you can do. And just to put a little bit of an emergency fund aside, so the market dips 10%, that's usually my break point. If the market drops about 10%, I'll start doubling up my buying and start getting a lot more aggressive, because it's always boded extremely favorably to those that have done that. But again, man, this market environment is just something else. And it's hard to remain strong when the entire speculation market's coming back. So just try and remain solvent if you want to trade. There's nothing wrong with speculating with a percentage of your portfolio, but I'd love to know what you're doing in this crazy market environment.